When you step into a five-star luxury resort, the world slows down. The silence and the invisible choreography of the staff and the highly manicured grounds are all calibrated to project an atmosphere of absolute ease. To the untrained eye, this level of aesthetic perfection suggests a highly profitable venture, an environment that seems to generate wealth as effortlessly as it provides comfort. But behind the elite brand logos and matted velvet curtains is one of the most capital-intensive and low-margin business models in the entire commercial real estate sector. The perfection guests experience is a manufactured environment masking deep structural economic instability. To see exactly why these monolithic assets are so precarious, we have to start with the ironclad law of hospitality real estate underwriting, the 1,000-to-1 rule. This formula states that for every $1,000 a developer spends per room, or what the industry calls a key, the hotel must generate $1 in average daily rate to justify its construction. If you build a standard mid-scale hotel, a room costs roughly $170,000 to construct. Applying the rule, you need to charge an average of $170 per night. In most U.S. markets, that rate is highly achievable, but ground-up luxury development shatters this math. The median entry ticket for a luxury property in the United States exceeds $1,057,000 per room. To justify that initial capital expenditure, the property must command an average daily rate of $1,057 every single night. This scale shows the mathematical disconnect. The required rate sits over $1,000, but according to national lodging databases, the actual average rate for luxury hotels is only $394. Hospitality economists call this massive chasm the valuation gap. If you underwrite a ground-up luxury hotel based strictly on standard room rentals, the project cannot clear its own debt service. To figure out why the valuation gap exists, we have to break down why a single hotel room requires over $1 million to build. Looking at this detailed breakdown of the capital stack, the first major hurdle is land acquisition. Luxury hotels rely on prime A-plus locations, requiring developers to pay land premiums that average over $78,000 per key. Next is the largest expenditure, hard construction costs. Covering the premium facade and the core building shell, this layer consumes 63% of the total outlay, draining nearly $700,000 per room. While standard hotels use mass-produced laminate to keep costs down, luxury brands require custom-designed case goods, stone surfaces, and bespoke lighting. This pushes the furniture, fixtures, and equipment budget to 16% of the total cost. And before a single guest ever checks in, developers face the financial drain of pre-opening expenses. This means hiring, paying, and training a full workforce months before the property generates any revenue. The baseline requirement for physical and service perfection creates a capital stack so heavy it threatens the feasibility of the entire project. In hospitality, physical space dictates profit. To measure how well that space is used, developers track the net-to-gross spatial efficiency ratio. Looking at the floor plan on the left, standard budget hotels are highly optimized. They convert up to 72, but on the luxury floor plan, spatial efficiency collapses to nearly 50%. Developers must build massive open lobbies, expansive staircases, and hidden employee corridors that generate zero direct revenue. Beyond the floor plan, the mechanical, electrical, and plumbing infrastructure creates another significant drain on the hard cost budget. This cutaway reveals the complexity required to deliver the luxury standard. Achieving silent climate control and high-pressure hot water requires redundant systems that consume up to 35% of the construction budget. Every dollar a developer spends to make the building more luxurious actively destroys its ability to turn a profit, widening the valuation gap to an unsustainable level. This leaves an obvious mystery. If the hotel mathematically cannot pay for its own construction, how do iconic brands actually get these buildings out of the ground? Developers bypass the financial shortfall through a strategic mechanism known as branded residential integration. They surround the hotel with private condominiums or oceanfront villas. These private homes are fully branded and operated by chains like Ritz-Carlton or Four Seasons. This flowchart maps the financial solution. Wealthy buyers pay multi-million-dollar premiums for these branded homes. That upfront cash injection is immediately used to pay down the hotel's construction debt. By flowing condo profits straight back into the capital stack, developers lower the net cost of the hotel rooms to a level that standard nightly rates can finally support. This mixed-use strategy has become so dominant that 69% of Marriott's luxury pipeline is now co-located with residential real estate. Modern five-star hospitality relies on a revenue stream beyond the nightly guest. Ground-up luxury hotels now serve as the marketing centerpiece for ultra-premium residential real estate. The isolated guest experience you enjoy on vacation is mathematically subsidized by the property owners next door. This structural bailout is the only way owners can face the high-stakes battle of actually operating the hotel day to day.
Welcome to the world of five-star hospitality. The water is perfectly chilled, the service is invisible, and the experience feels entirely effortless. It is easy to look at a room rate of $2,000 a night and assume the owner is minting a massive profit on every booking. This waterfall chart breaks down the two distinct measures of hotel profitability. We start with gross operating revenue and deduct the direct departmental operating expenses, like housekeeping labor and food costs. What remains is gross operating profit, or GOP. The luxury industry average hovers around 38%, creating a surface-level impression of a high-margin business. But GOP excludes the fixed overhead required to keep the asset alive. When we deduct management fees, property taxes, capital reserve contributions, and building insurance, that 38% vanishes. The actual cash available to service debt and pay investors, net operating income, often collapses to a narrow 8 to 10. In five-star lodging, the staff-to-guest ratio is the defining metric of quality. This graphic illustrates the typical requirement. 2 to 3 full-time employees are needed behind the scenes for every single guest room. Efficiency is limited by the physical complexity of the product. While an economy motel attendant might clean 18 rooms a shift, look at this luxury layout. Between custom stone finishes and multi-fixture bathrooms, a luxury housekeeper is strictly capped at 8 to 12 rooms per shift to maintain brand standards. In major urban markets, this labor force is often heavily unionized under groups like Unite Here. Operators are currently paying 22% more for labor than they did pre-pandemic, even as total hours worked have decreased, as unions successfully negotiate for higher wages and strict productivity caps. These fixed labor costs turn any dip in occupancy into an immediate problem. When the staff is the product, you cannot simply cut your way to profitability without destroying the hotel's market position. To protect their net income, owners focus on ancillary revenue, monetizing guest spending in departments beyond the nightly room rent. Food and beverage is often a labor-intensive liability. Staffing costs alone consume nearly 60% of every dollar generated in the kitchen. When you add the cost of premium ingredients and operating supplies, very little profit actually reaches the owner's bottom line. In contrast, the spa and wellness department is the owner's most efficient profit engine. These services operate on margins as high as 70%. High-end retail products and massage services provide a significant return on every square foot, with a fraction of the staffing required for a restaurant. This operational complexity is managed by separate entities. Most luxury owners partner with global brands under a hotel management agreement, or HMA. The brand operates the property, but they do not own the real estate or absorb the financial losses. This chart shows the inherent tension in that partnership. The brand operator earns a base fee, the green line, based on total revenue. They profit from volume, regardless of whether the owner's net operating income, the red line, is being pulverized by rising labor and insurance costs. The operator is effectively insulated by the contract, earning fees while the owner manages the volatile reality of the physical asset and its overhead. The industry is now approaching a $48 billion commercial debt maturity wall. This represents a concentration of hotel loans coming due, at a time when the capital markets are in a state of friction. This chart compares the debt service of the recent past to the near future. Owners who financed at 3% during the pandemic are now facing market rates of 7% or higher. For a single luxury property, this interest rate shock can slash annual cash flow by over $1 million.
Lenders are tightening requirements, just as brands are mandating property improvement plans, or PIPs. These non-negotiable physical renovations are required every 7 to 15 years. A luxury guest room renovation can cost $35,000 per key. Layered on top of increased debt service, this total cost often exceeds the hotel's cash flow. This convergence of high debt costs and forced physical upgrades creates a cycle of distress. Owners who cannot cover their debt service are forced to sell, allowing opportunistic investors to acquire these assets at a significant discount to replacement cost. To navigate this environment, sophisticated owners are adopting a specific strategic playbook. First, they are diversifying the capital stack by integrating branded residences. Selling private units up front generates the cash flow necessary to subsidize high construction and acquisition costs, reducing the reliance on debt. Second, they are optimizing labor through data. Owners are moving away from fixed shifts toward 15-minute demand-based scheduling to ensure the workforce is sized exactly to guest volume. Third, they are maximizing the attachment rates of high-margin spa and wellness services. Converting guests into spa users is the most efficient way to grow the bottom line without the high labor cost of traditional F&B. In a mature lodging market, protecting the operating margin is the definitive growth strategy. Success depends on treating asset management as a discipline, rather than a passive investment, ensuring that every dollar of revenue actually reaches the bottom line.